Hello, this is George Geis. Welcome back. In this video, we'll be talking about the income statement. Now, this is the second of the big three financial statements. Remember, I mentioned earlier, there's three legs holding up the tripod that communicates about your company. The first is the balance sheet, the second is the income statement, and the third is the cash flow. Now, here we're focusing on the income statement. Now, the income statement is different than the balance sheet in that is more of a moving picture of the operating activities of a firm over a period of time. For example, from January 1st to December 31st, 2015. Remember, the balance sheet was a snapshot in a moment of time of your investing and your financing. The income statement is a moving picture that covers the activities over a specific period of time, usually a year. Sometimes, if you're a public company, it's 3 months that you report temporarily every 3 months. But normally it's once a year, at least, you're going to be putting together an income statement for financial reporting purposes. Now, your bank, as an entrepreneurial venture, may want to see an income statement monthly. But in general, here we'll be focusing on is income statements that cover a period of time, in this case, 1 year. Now, it's pretty simple in the sense that we're looking at your revenues and you're subtracting your expenses. We're measuring your profitability. Now, we're going to see that this statement has a specific connection to the balance sheet in a later video. But right now, we're focusing on the fact that we're measuring profitability. Now, as an entrepreneur, think of yourself as driving an automobile. You have a dashboard. There are certain indicators which are particularly important that you look for. One may be the fuel gauge. Another may be your oil pressure. The other may, of course, be your speed that you're driving. Similarly, an entrepreneur has to look at certain indicators that are important to the dashboard, his or her dashboard. And certainly net profit is one of those indicators. It's not the only one, as we'll see. Later on, we'll discuss cash flow, and we'll see how that also is an extremely important indicator. Now, it measures how successful your company has been in achieving its profitability goal for a given period of time. Now, as before, the income statement, you're looking through a rearview mirror. Unless you're projecting future growth possibilities, when you're reporting your income on your income statement, you're looking backwards in time. You're reporting historical information as to what has occurred. So, and again, we're talking here about a rear view mirror. Now, later on, we'll be talking about projecting financial statements, what we call pro forma. But here, we're talking about historical income statement. Okay, so here is Microsoft, for example. We've been working with this company. Let's take a look at this. Notice that it's pretty straightforward. I've got the revenue of $86 billion, almost 87. Remember, this is the year ending June 30th, 2014. It's for 12 months. It describes the activity that occurred during that entire period. I've got gross margin. The gross margin is your revenue minus your cost of that revenue. In Microsoft's case, notice that it's pretty high. It's probably close to some 70%, which is a relatively high gross margin. Other companies, your company may not enjoy such high gross margins. An online realtor, for example, like Amazon, has much lower gross margin because of the cost of the product that it's selling. In Microsoft's case, it has substantially higher gross margins. A company like Google also would have very high gross margins, given it's in the advertising business primarily. And that business is known for its high gross margins. Now, as Microsoft moves into other items like game consoles, again, that gross margin might be affected. Your gross margin will vary substantially based upon the line of business that you're in, but it's an important subcategory. And again, it's revenue minus the cost of your revenue, the direct costs associated with manufacturing or providing the services that you provide. Notice that Microsoft doesn't break out a lot of other expenses. This is not in great detail. It breaks out research and development, sales and marketing, general administrative. Those are the big three that it breaks out. Now, curiously enough, if you look at this, you'll notice that sales and marketing is higher than research and development. In fact, it's the highest, what we call operating expense. It's not as high as cost of revenue. But once we get past cost of revenue, the sales and marketing component here is pushing, 20-25% of revenue. The sales and marketing is 15 billion, the revenue is 86, so we're between 20 and 25%. That's pretty high. You might say, well, why does a software company have to do such marketing? It's not as high, by the way, as you might find with some other companies which really have to put a lot of advertising, like Procter & Gamble, selling soaps or whatever. They may put even more into sales and marketing, but I want you to notice that here is a technology company that puts a substantial amount of expenditure into sales and marketing. Now, the question you want to ask yourself is, to what extent, how much are you going to put into sales and marketing? And in fact, you may want to track this carefully based on what your competitors are doing. But it's not just how much money you put into it, it's obviously what you do with that money that's effective sales and marketing effort. But notice, here's a technology company with its highest operating expense, sales and marketing. Now, general administrative has to do with the management staff, the sales, the executive team, and all the expenses that are associated with general administrative expenses. Notice for Microsoft, G&A between 2013 and 2014 actually went down. Then we come to the operating income. This is the next major subtotal. We saw one with gross margin. Operating income is an important concept for you to know about. It is the income that you have generated from your core operations. Doesn't include interest that you've earned or interest that you've paid. Now, by the way, we've noticed that the operating income aspect here is an element which is extremely vital to communicate to investors, because this, once again, shows the extent to which you're generating income from core operations. The taxes are taken out, and finally we get down to net income, which is $22 billion. This is net of taxes. Whenever you hear the word net income, you're talking about bottom line. So on an income statement, there are many different forms in which you can take. We're looking at just one, Microsoft in this case, how it's broken down its income statement. You look at other income statements, you may break down other categories, but you're talking about key lines being gross margin, operating income, and net income, which basically takes out all expenditures, including taxes, in determining this important element of profitability. So, to summarize, the income statement shows results, profitability results over a period of time. It demonstrates the level of success over that period. Now, as an entrepreneurial venture, you may not have positive net income in the early stages of the venture. It may very well be that you're positioning yourself to build a company. For example, you may be building a sales force. The sales force may not be totally productive in the initial years. They're being trained. You're building a brand. And sometimes you have to put advertising in before you're getting the resultant sales that are associated with that advertising. So we're looking at Microsoft here as a very profitable company. Let's hope that all of you get to that level of profitability. But in your initial stages, you may find that you have an operating loss in the initial years. Just like with the balance sheet, the whole story may not be told because you may be positioning yourself for rapid growth in the future. And as long as you're doing that, you're making plans and building the team and making the expenditures which are helping you build for your future, it may be just fine if you have operating losses in those early years. Now, you can't continue on like this forever, but for the early years of a venture, you may find yourself exactly in this position. And again, the summary idea behind the income statement is revenue minus expenses is your net profit. Now, looking ahead, in the next video, we'll be talking about a very important statement called the cash flow statement. Just as the income statement is a key indicator on your dashboard of profitability, the cash flow statement will be an equally important statement of your liquidity.